Welcome to today's webcast. KPMG has been approved by NASBA to deliver CPE-worthy training. In order to receive CPE credit, you must attend for the entire session and participate in interactivity checks. Interactivity checks will appear on top of your media player and may or may not be verbally addressed by presenters. Participation is tracked, and failure to participate will result in denial of CPE credits. If you have any technical issues during the webcast, please submit a question through the questions and answers panel, and our producers will respond to you directly. Please submit all content-related questions through the questions and answers panel.
Hello, and good morning, afternoon, or evening to everyone. We thank you for joining us and welcome you to the Financial Services Industry session of the Global Financial Reporting and Valuation Conference. My name is David Conup. I'm a principal in the Valuation Services practice with KPMG, and I'll be guiding our journey throughout the next hour. We have some fantastic speakers with some deep industry experience on the highly relevant and fascinating topic of ESG. So we're looking forward to a lot of good exchanges coming up here. We'll be starting with the asset management subsector and then moving into insurance and banking. Within the asset management subsector, we have Angela Tai and Jamie Franco joining us, so please allow me to introduce them. Jamie is a Senior Vice President and Head of Fixed Income ESG at TCW. And before assuming that role, she was a Senior Account Manager and Product Specialist within the Client Services Group. She was responsible there for communicating investment strategies, performance, and outlook. And before joining TSW, Ms. Franco was with the U.S. Department of the Treasury for over a decade and served multiple roles there, including Senior Advisor to Treasury Leadership in both domestic and international divisions, International Economist, and Deputy Director of the International Banking and Securities Markets Office, as well as being an advisor to the U.S. Executive Director at the International Monetary Fund for several years. Angie joins us from the KPMG side. Aside from being a former audit partner extraordinaire, Angela now leads our ESG accounting advisory services for the financial services industry to ensure delivery of our expertise, solutions, and industry insights to our financial services clients as it relates to existing and emerging ESG frameworks and disclosure requirements. Angie has over 18 years of experience in our capital markets sector and has served primarily in asset management and has also served as a lead partner on several ESG and impact funds. So with that, I turn the floor over to Angela and Jamie. Please take it away.
Thanks, Dave. I'm excited to spend the next 20 minutes with you, Jamie, to discuss the current ESG environment within the asset management industry. But before we do so, can you give a brief overview on TCW?
Yes, of course. First of all, thank you so much for having me. TCW was founded in 1971. We are a global asset manager with over 200 billion assets under management. We're headquartered in Los Angeles, but have a number of people globally working in different jurisdictions. And we also cover the waterfront in terms of asset classes in both public and private assets. We have fixed income, equities, emerging markets, and a private credit business. So ESG ends up touching us in a lot of different ways across the market.
Great. Well, let's get started since we're pretty limited in time before the next set of speakers. There's an alphabet soup of regulations impacting the asset management industry, from SFDR to the proposed SEC rules. How has TCW navigated the current regulatory environment around ESG? And what is your view on some of the SEC proposed rules impacting the asset management industry? Also, do you think the forthcoming regulations are the answer to bringing the much needed standardization to reporting on data?
Yeah, there's a lot there. So maybe just starting at a big picture. I think it's great that there is so much regulatory attention in this space. It's well needed to help guide asset owners, asset managers, investors, to make sure that we're really doing investing in the way that our clients are looking for in a very credible way. Obviously the field has grown a lot in terms of the number of funds, in terms of the assets under management. And so it's helpful to have some sort of guide rules. That said, we have to think about this like a marathon. If I take a page out of my prior experience working on things like global financial regulation or accounting standards harmonization, this is going to take decades to really get right. And so once you come to that acceptance, it changes, I think, your disappointment slightly that there isn't more standardization and there isn't more definition. And that can be frustrating as an asset manager to navigate a bit. So that's one point. The other point is a lot of this regulation is attacking things in different ways. So broadly, if I were going to characterize things, regulators in some ways are emphasizing disclosure, obviously, as an important feature. Some are advocating for labels on funds, and others are basically taking a very top-down view that says this is what's green, and this is all you can invest in, and this is how we define these things. That is a challenge to navigate. And what is green in one jurisdiction isn't green in another jurisdiction. That means that you have to navigate things very flexibly. You have to build your systems, your analytic tools, your research frameworks in order to be able to provide multiple solutions to clients across the globe. And we can only hope that 2023 brings a lot more attention on how to define certain things. I think that's really important. And here you have not just the regulators, but also, organizations such as the International Sustainable Standards Board that got created. This is a really important board. And in fact, this morning came out with a definition of what is sustainable. That's very helpful. Hopefully regulators adopt that in part. Certainly would help for some harmonization across the waterfront. At the end of the day, my last point, standardization isn't necessarily going to be the solution. Asset managers will have different approaches to this. We all have different definitions of what is good and bad from an ESG perspective. And I think that's fine, provided that we're all disclosing the information in ways that help investors make informed decisions. But that means as an asset manager, you can't sit back and wait for this to be presented to you nicely with all the definitions and templates and everything synced up, because it just isn't going to be, and it won't be for a while. So, I'm overall optimistic, but there's a lot of work to do on everyone's part to make sure that we're best representing what we're doing in our investments.
Great, thank you. And in the U.S., like kind of going off of regulations, but going into the political environment, the political environment currently in the U.S. has paused some of the momentum ESG has gained in recent years with anti-ESG state legislations and states pulling funds from certain asset management firms due to their ESG investment policies. What are your thoughts on the current political environment in the U.S. and the controversy around ESG?
Yeah, it's a very important debate to a certain degree, because, while you're not going to be able to convince everyone that climate risk is in fact financial risk, we believe that, there's a big element of education that everyone needs to participate in, particularly asset managers who really feel like a lot of this information is necessary for helping deliver long-term risk-adjusted returns. And what I mean by that is, values-based investing, where a client tells you not to invest in fossil fuels, is something that we certainly apply across whatever strategy they're invested in. That's not something that we apply firm-wide. But that's definitely a preference of some of our clients. And we should be really clear about that we're managing our clients' money. And we are implementing guidelines the way our clients are asking us to. ESG integration, on the other hand, is integrating data that we think is very financially relevant into our research frameworks. That's not saying that you can't invest in fossil fuels, but that's maybe saying you might not want to underwrite that coal plant because you think that's going to be a stranded asset in a few years, and that's going to impact the valuation of that security in your buy and hold portfolio. That's something that is really relevant to spreads or stock prices, however you're investing. And there's a lot more data that's available as well. How many of the fixed income investors had exposure to commercial properties in some of the areas that have been hit by wildfires and floods? That's important to be able to say, we have exposure, we've evaluated the risk, and we've quantified it this way. And we feel like we're being compensated however we're investing in that part of the market. If you don't integrate this data, you can't answer that very relevant question. So I think it's a shame that the values type investing gets conflated with what is really good risk management. And so we try very hard to educate everyone that I talk to, whether it's clients or, industry groups, whomever I can get in front of, to just say, look, we have to separate out and be very clear on our terminology. Because if I tell you I have a good ESG name, you might not know what I'm talking about. I certainly wouldn't know what you're talking about. I don't know, and that's part of this problem, right? Is that we need to be much more clear about what it is we're doing, how we're using this information. And then on the other hand, you have clients who very much want to underwrite the climate transition. They want sustainable investments. They want net zero portfolios. So again, we are here to invest on behalf of our clients. So we will be developing and have developed the ability to facilitate that type of investment. But that's very different than what, a client who just wants integration to be part of the approach. They're totally different. And as I said, I can't emphasize enough how important it is to be transparent about definitions.
Great. We talked about some of the challenges around ESG, but what do you think are currently the biggest issues impacting asset management firms related to ESG?
Yeah, this is a big undertaking. You've asked two questions, I think, that really point to the greatest challenges. But on the back end, what's the implication of that? In order to do this effectively, in order to define things, you can't just hire 4 research analysts. You have to spend a lot of money on data, spend a lot of money on data architecture, building automated reports, integrating things into compliance systems. Your compliance people need to be fluent with what is a carbon target. I mean, you need legal assistance beyond, I think, what would have traditionally been sufficient 10 years ago. You just need more resources across the firm. And so, I definitely feel like ESG integration, certainly, and the ability to provide these solutions to our clients is table stakes. It's very important to get this right. And getting that right means that you basically have to build out an entire business line and integrate it into your typical processes and procedures. And this is evolutionary. The biggest challenge on here is that in some ways we're building the plane while we're flying it. If we take SFDR, for example, these are regulations that apply to fund managers, but they haven't yet compelled the disclosure by the companies that we're managing. So I'm being asked to report data that doesn't exist in the marketplace in a standardized way today. And we just have to deal with that. That's how the regulators have set it up. But, that entails certain frictions and risk as an asset manager, and you need to have the partners across compliance and legal and on your investment teams to help you make those informed decisions on how to approach this.
Great.
One last thing I would say, the biggest issue that's coming up with our clients is how do we help finance climate transition to low carbon economy? How do we change our energy mix? And this is clearly a very large issue for humanity, but has been particularly focus of clients who've seen things like the legislation that's passed in the US, the IRA bill, the legislation that's passed in the EU. It's clear that there are going to be opportunities and financing for new technology and development that is disruptive. And how do we as investors capture those opportunities for our clients in fund vehicles or other kind of separately managed accounts. And so I'm very excited about what we can be doing there and the potential opportunity that has in the market. But it's nice to see that aligning with client demand is one we'll have to definitely make some strides in 2023.
Awesome. Well, thank you, Jamie. With that, our time is up. Thank you so much for your time and also for providing your insights. I'm now going to pass it on to Dave, who will introduce our next speaker. Thank you so much.
All right, Angela, Jamie, thank you both very much, and thank you for the insight and the education. It's terrific to hear that. We're going to turn our attention now to the insurance sector, and we have Dawn Emling and Sean Vicente, whom I'll briefly introduce. Dawn has over 15 years of experience in the overlapping sectors of environmental, social, and government, corporate social responsibility, sustainability, and social impact. So beyond ESG. Dawn is currently VP, Head of Sustainability Initiatives at Lincoln Financial, and her previous roles include the Head of Sustainability for Thomson Reuters, the Head of Sustainability EMEA for Credit Suisse, and the Head of Community Investment and Sustainability in Asia for Credit Suisse. Earlier in her career, Dawn was also a senior advisor to the United States Agency for International Development with a focus on democracy, human rights, and civic participation. Sean is a senior partner with us at KPMG in accounting advisory, specifically in the insurance practice, and has lead responsibilities in ESG for that sector. Sean's also the managing partner in our Des Moines office and has worked in the insurance space for almost 30 years, and that includes M&A, accounting change services, and audits of financial statements and internal controls. So with that, Dawn, Sean, please take it away, and let's talk about insurance.
Great. Thanks, Dave. And really thanks to Angie and Jamie for your comments. I think it really helps frame the conversation we're about to have. We could focus this on insurance, but I feel like financial services, we all share a lot of the same language and the same interests. And so I think what we'd like to do here with Dawn and my time is spend a little bit of time on the how. Dawn and I have had a chance to chat and have really kind of learned a lot around how Lincoln Financial has thought about this and how they've evolved their processes and built this out. And so really want to kind of dig in a little bit on those ideas to kind of build on the framing that we just got from Jamie. So Dawn, thanks first for being here. Really appreciate you spending time with us. I have enjoyed preparing for this. Can you just maybe start a little bit with your role at the organization and as we think about this, it's not in the weeds so much, but as you think about governance and how Lincoln's thinking about organizing around this, how does your role fit into that amongst other roles, kind of at the higher end of the structure around ESG?
Yeah, thanks, Sean. Delighted to be here. Thanks for the invitation. And I was also quite curious to hear Jamie's conversation because we're flipping that a little bit onto the corporate side. So happy to provide some insight. I'm lucky in the first instance to be with Lincoln for over about 3.5 years now. They have a very strong track record in ESG, a couple acronyms that people will probably know, but we've been on FTSE for Good since 2001. We've been reporting our carbon footprint to the CDP since 2014. And as of last Friday, we are on Dow Jones Sustainability Index for the 7th year. So we're delighted about that. I think that speaks to the commitment by the company to ESG and transparency. It really has been, as Jamie said, an evolution. When I was in this space, even 5 years ago, it was about the process of your environmental footprint, about your ethics and supply chain, about awareness around the enterprise. It has turned very dramatically into a data management and data kind of transparency, ESG disclosure role. So what we're seeing in the last 4 or 5 years is a real interest from external actors, including investors like Jamie, on not only our processes, but how are we measuring that? What is the data that we're cleaning, scrubbing, getting through compliance and out to the market so that people can see and benchmark what we're doing in terms of ESG? We as a firm report and submit to almost all the big surveys that everyone knows. We engage regularly with the ESG data providers. We have put our we've disclosed against the frameworks TCFD and SASB. I would say overall, we are managing over 1,500 data points annually on ESG through the company. So Jamie's absolutely right. The interest is in the ESG data. And fortunately, we're comfortable with the transparency there.
Yeah, that's great. And it kind of sets the table. I mean, with all of 1,500 data points that you have to manage, as you all have kind of thought about building out the capabilities in your organization, maybe a few of the important decisions that you all have made as you've gone through that process, things that you think were important steps along the way.
For sure. We have to think through the stakeholders when we think through those decisions. So we have a number of stakeholders, not least of which are investors, also proxy advisors. Our clients and our potential clients are asking about ESG data now, our employees, and then, as we're hearing, absolutely regulators. So we have strengthened our procedures. We have in place a number of structures that help us oversee ESG disclosure and our ESG management. We have board governance in certain committees. Our chief sustainability officer reports twice a year. We have a quarterly sustainability advisory group of senior leaders from across the enterprise. We brief them on trends, what we're seeing in the market. And then in the last 2 years, what we've done is we have a network of subject matter experts. I think at this point we have about 90, and they also use the lens of ESG in their roles. And we brief them quarterly on the same issues that we brief our sustainability advisory group. We see this embedding of ESG lens in the business as kind of the top of the pyramid. It's where people strive to be. It's not just about reporting. It's making sure everybody in the company knows what you're doing and are part of that process.
Yeah, no, it makes total sense. So as you've kind of gone through some of that building, maybe similar to maybe the question we asked of Jamie, I'd be interested sort of any lessons you've learned, any pitfalls along the way that you've encountered.
Yeah, I would say over the last 2 years, it's been the data. It's all about the data now. So we have spent significant time getting our software in order. We use an outside provider for our scopes 1, 2, and 3 for our GHG footprint. We have that audited internally and then externally, and we put that data out on our webpage and through the CDP. That has gotten cleaner and cleaner. We are very confident in that data, and we will need to be given where the SEC is likely headed. On the other 1,500 other questions around ESG, so supply chain, diversity and inclusion, talent development, we were doing that by push and pull email, Excels, and Office, Microsoft Office. It was very cumbersome. So we took a pause about 2.5 years ago. We worked with our IT solutions. We came up with a project management tool that puts all of this information in a ticket. We send it to the subject matter expert. They revise, update, improve, comes back to us. Then we send it to SVP, senior management, for approval. We now have a track of that year on year. We also have a clean, we can use it for any requests. Not surprisingly, we call that the ESG tracker. I think I've heard only 20% of, I think, Fortune 500 are using a database to track this ESG data. It has saved us inordinate amount of time and resources over the last 2 years. So I would recommend that to anyone who is starting to get asked these questions or is starting to step into this space.
Yeah, because that really kind of leads to, as we think about assurance and some of the things that are being discussed around all of this disclosure that they're asking, I want to double click a little bit on your comment around internal and external audit of the data. And there, how has that process gone? What were sort of some of the initial challenges that maybe you experienced going through that? Because I think that's one of the parts everybody's sort of thinking about and probably hasn't yet figured out exactly how they're going to be able to respond to questions from auditors.
Yeah, so we're fortunate that our footprint is not particularly large as a life insurance company. So we're fortunate that the software we use, our facility managers actually submit their electricity bills directly into that software. That gets scrubbed by the vendor, and then we can allow both our internal auditor and our third-party auditors into that software to look and take sampling and identify where we might be falling down. We believe that we're going to kick the tires on that for the SEC, because that will also need to be, auditable at a certain level. So I would say get that in order first. The GHG footprint, obviously, if you're in a sector where you're high intensity carbon, that'll be a much bigger lift. But yeah, I would say a software is probably first in order, and then getting all the other soup of questions probably comes later.
Yeah. Okay. Well, that's great. Well, appreciate your time and all of those insights. Certainly I've enjoyed the conversation and appreciate you being here. So thank you. And David, I'll turn it back to you.
Thanks.
Sean, Don, thank you guys very much. Very informative and kind of an interesting dovetail with what Angela and Jamie had to say as well. Interesting how we're all tied together here in the financial services industry in general. So our final segment will actually be in what we call strictly the banking space. So we have Mario Mastrantoni, an advisory partner with KPMG, and Mike Tubby, who's Bank of America's corporate sustainability controller. They've been kind enough to do a bit of their own introductions, so they'll give you their bios. So with that, I'm going to turn it over to them to talk through some of this fascinating topic around banking.
Hello, everyone. My name is Mario Mastrantoni. I'm a partner in KPMG's Accounting Advisory Services Group, and I'm based in Charlotte, North Carolina. With me here today is Mike Tubby. Mike is the Corporate Sustainability Controller at Bank of America, which is a newly created position. Mike, it's great to have you here with us today, and we look forward to hearing some of your insights around what Bank of America has been doing around ESG and sustainability. So along the lines of your new role, we're starting to see the emergence of these types of roles, often referred to as the ESG controller. Can you talk about your role, but also the importance of the position and the role it plays in integrating traditional financial reporting, risk and controls with ESG and sustainability?
Yeah, and Mario, I'm happy to be here. I am, as you pointed out, I am Bank of America's first named corporate sustainability controller. And, I want to just hit on something you said about the integration of what I'm going to characterize as sustainability information, this ESG or non-financial information with typical financial reporting. And, what's really come about here in the last couple of years is, and it's been going on for a lot more than that, but this momentum around the way that investors are evaluating a corporation's performance using not just the financial reporting, which is everything that we think about in terms of cash flows and net income and earnings per share, et cetera, but an expanded report card of performance that incorporates environmental reporting, social reporting, and governance reporting to, I would say, get a complete picture of an enterprise's performance. And, from my perspective, I would just go ahead and add in here that I personally believe that sustainability reporting encompasses financial reporting and non-financial reporting, i.e. the E, S, and G, and that in totality, all of that is sustainability reporting. It's really fascinating when you start looking at some of, I would say, the thought, kind of the leading thought around where this could go. And in some sense, what you start to see is the chief financial officer as the chief value officer. And value encompasses, all the things that we typically think about from a financial reporting perspective, and that expanded report card along the lines of the ESG dimensions. And that in its totality is part of a corporation's total value. And so, my role is really taking that expanded view and evaluating, do we have an appropriate control environment for all of this other information? And are we using the best, I would say, the things that we've learned as CPAs and in finance in terms of financial reporting, the best lessons, are we applying those to our non-financial reporting? And are we getting to an integrated whole so that the users of our financial statements, which, and I think let's take, and our voluntary ESG reports, and I can get into more on that later, because I think at some point it will be required reporting. We're not there yet, but that's clearly where we're headed. That picture, conveys to the users of those financial statements our total enterprise performance. And so, in short, Mario, I guess I'll pause there. I know I kind of made it a little short shrift of that question, but I think fundamentally it's really key, and it's important that we all start thinking about this in, I would say, this kind of new paradigm.
Thanks, Mike. Really great insight. And you raised some great points on the integration and the responsibilities in the traditional, financial reporting sense. Have there been any challenges? And I know it's early days, but have there been any challenges sort of with that integration and getting maybe the folks that traditionally have done ESG and sustainability reporting at many companies? They're typically not, financial reporting and controls focused. And so have you had any challenges with that transition or gaining that type of acceptance across the organization?
But what I'll say, Mario, is that really the key element as we move to, I would say, an environment where you start to think about controls along the lines that you do in financial reporting, is that there's a huge kind of educational process that has to go on. And I think the interesting thing about ESG is that you've got people in all different parts of the organization. So you've got, for example, at Bank of America, you've got ESG reporting. You've got our global environmental group, which is tasked with greenhouse gas emission reporting, as well as thinking about net zero targets and how those targets will be achieved. And Then you've got our global climate risk function, which is part of the Chief Risk Officer organization. And you have other parts of risk that is very involved in thinking about things like scenario analysis or credit risk, for example. So a lot of the existing functions in the Chief Risk Officer organization are thinking about this as well. And then you've got our front office, our lines of businesses that are thinking about how we can most effectively support clients in their transition to a lower carbon economy, and as well as achieving various other ESG objectives. So it's when you think about the scope of sustainability reporting, it encompasses just a huge chunk of the organization with, multiple lines of businesses, many of our traditional back office functions. And so, with that scope of professionals and employees and resources, again, I'll come back to, there's this huge educational process to help, talk about what do we mean when we talk about controls? What do we mean when we talk about a control environment? What are best practices when it comes to documentation? I think, Maria, the real key in my mind is that educational challenge that comes with, putting together a program that includes all of the various functions of the enterprise, gets everyone to a place where they're thinking about control environments and controls and what's the proper level of documentation to be successful in again having a great foundation for transparent and accurate reporting. So I would say, we face a challenge, and I think in a large part that challenge is all about education.
Great. So it really seems like a true organizational transformation to be successful, and to be a leader like Bank of America is in the ESG space. It really does take a great deal of investment, organizational buy-in, cross-functional coordination, accountability, and education, as you just said. So how important is it to have the support of senior leadership to be able to be as successful as you've been?
Super important, Mario. And we've got from the CEO and the CFO and the Chief Risk Officer and all something at Bank of America, which we refer to as our NTM, or it's really the senior leader management team body, and these are all direct reports to the CEO. They participate in what we refer to as a responsible growth committee. It is a committee that is evaluating that really is responsible for overseeing our ESG reporting, overseeing our sustainability strategies, and setting the direction that the firm is going to go in, and along in terms of everything that's sustainability. And they meet regularly. We had Brian Moynihan, who was just at COP27, and other senior leaders were there as well. So it's really something where that senior leader support and direction is critical to the success of the organization. I mean, I think we all know this, Mario, how important it is, and that's something that I see every day at Bank of America, and it's one of the things that honestly makes me really proud to work there, is seeing how much the leaders of Bank of America care about leading the way when it comes to sustainability reporting, and understanding that really that sustainability reporting is a way to measure our performance towards achieving things like the United Nations Sustainable Development Goals, which is something that we care deeply about in the organization. So super critical, Mario. That's what I'd say.
Okay, well, thank you. So along similar lines, Bank of America is one of the leaders in the clubhouse on ESG and sustainability reporting. So obviously you need to have the ambition to be a leader, a market leader. But beyond that, what advice would you give to other organizations that similarly want to be a market leader in the space?
You know, I think that number one, ensuring, I think there's a number of things. I mean, we have an ESG policy framework. It's available on our website, and you know, anyone can go and look at it. Talks about how important this is to us as an institution. I think setting up the appropriate structure where you've got senior leaders of the organization with you know, proper board support, thinking about sustainability and directing an organization on what it needs to achieve and what its focus should be. I think that, for example, you know, part of our process in evaluating this is you know, we have a board of community leaders that we consult as well. So making sure that you have appropriate input in that strategy setting process, I think is super important. And then ensuring that you've got a coordinated approach that recognizes how broad the scope is of sustainability within an enterprise's operations, and then ensuring that the leaders in those functions are informed, educated, they're on board, and then ensuring as well that the organization has proper resources to, you know, carry this out. So I think philosophically it starts from the top with a corporation's leaders and board supporting where you want to get to, and then ensuring that you have the appropriate change mechanisms in place to, you know, achieve those goals. And then, you know, like you said, Mario, you talked about accountability, cross-organizational coordination. It's all of that. So this is really a massive change project. So when you think about all the ingredients that have to be there to support a large-scale change program within an enterprise, that's what you have to have. So
thanks, Mike. Long journey.
I'll leave it there.
Long journey.
Yeah.
Maybe one final question to wrap. We can't wrap without talking about the SEC's climate rule, climate risk disclosure proposal. Maybe you could hit on just a few of the most challenging aspects that you see with the proposal, and whether or not you think that might change the nature of any of your voluntary disclosure information, maybe how that might impact what you disclose under your TCFD or other sustainability reporting.
Yeah, you know, I think, Mario, and I've actually seen a lot of information on this in terms of kind of the things that we thought about a lot are the SX requirements. And so, you know, this is reporting expenses, costs, et cetera, that are over 1% of an entity's, you know, income statement line items, cash flow statement line items. You know, that's very significant. I think there's a tremendous amount of operational hurdles associated with that. You know, that's something that we called out in our letter, that you've got all kinds of policy decisions that would go into that. And it's not clear to us that you would have any kind of consistency across organizations. It would be, I think it would be a massive change, something along the lines of what we think about, for example, when we went to CECL or when we adopted the new revenue recognition standard or leasing. It's really kind of a massive change in terms of GAAP and what it would require. I think, there's, when you really get down into the nuts and bolts of how you would make that operate, the effort that is required is really tremendous. So that's number one. I think number two, Bank of America is supportive of greenhouse gas emission disclosures. The thing that I would say is there are, especially for a bank, when you're thinking about financed emissions, and everyone here in the conference may or may not be familiar with that concept, but basically, in theory, what that means is if you're loaning another entity money, then you are responsible for financing a portion of that entity's operations, and therefore a portion of that entity's greenhouse gas emissions are attributable to you. And that's the whole concept of financed emissions. There are huge data quality issues associated with financed emissions, in addition to just fundamental things about, for many different types of assets, there are, the models are still in development on how you would even calculate that. And so, there's a large volume of assumptions that have to be made. And so, ensuring that there is sufficient time to get prepared for financed emissions reporting is, really critical. And also recognizing that a lot of this data is only available on a significant lag, which could be up to 17 months, for example. So, I think this is one of the things where you said, look, there should be something in the standard that talks about using the best available information. That information may be dated, if you will, by financial reporting standards, but it may be the most current information that we have. And hence, that's what we should be able to use to support this disclosure. I think the other thing that's really important for people to keep in mind is that, with climate change and with greenhouse gas reporting, that models are going to improve. Data quality is going to improve in time. And we're going to get to a place where this type of reporting is on par with financial reporting. But that's going to be an incredible journey. And, it's important that we don't stifle innovation and moving down the path towards, kind of a high quality solution a la financial reporting. And we want to make sure that the guidance that ultimately we get from the SEC is supportive of that innovation, that it helps people and encourages companies to make progress without raising a bar that's so high that by some standards it could be cost prohibitive to really get there. And again, in a lot of cases, this information simply does not exist. So I've been in several industry discussions where SEC staff were there. I think that's a critical message that comes up. And I think in a lot of ways, Mario, and I think I would just call out safe harbors, which is another thing that we've highlighted in our letter. It's we think it's really important that there be safe harbors for all the reporting that's included in a 10K and a 10Q when it comes to climate risk reporting. Just given how new all of this is, how new the models are, how and I know the greenhouse gas protocol has been around for a while, but again, I think in some sense this is bringing all of this into a realm where you've got accountants and auditors and lawyers and regulators all looking at this information, raising questions, wanting to move it to a place where, again, the quality is similar to what we expect in the financial reporting regime. So, yeah, and sorry, Mario, I know I've kind of rambled on there for a bit, but it's really important. So again, these are some of the key messages that we called out in our letter.
Well, thank you, Mike. Really insightful. Really appreciate your time today.
You're welcome.
All right, terrific. Mike and Mario, kind of closing us out here with the financial services or banking direct view of ESG. So I think we've had a lot of very fascinating speakers today, and I wanted to thank Mike, Dawn, and Jamie for joining us, and I want to thank Angela, Sean, and Mario for helping to host. We've heard a lot about ESG. We're still early days, right? I think Jamie said flying the plane while building. We're still talking about terminology. We're still talking about information usage, getting the message out, bringing in stakeholders, whether they be external, such as clients, or internal throughout the organization, and the importance of tone at the top in terms of executive participation. A lot of information and still early days in the ESG space here. So since we did discuss so much, we haven't left adequate time for a Q&A session, but to the extent that we have any submitted questions through the chat or any subsequent contacts, we will be making every effort, and every effort will be more than enough for us to get back to any people who have any questions or further topics they want to discuss with us. We hope that you've enjoyed the session today. We very much appreciate everyone carving out part of their day to join us for this, and we look forward to seeing you again at a webinar or even in person sometime soon. So thank you very much, everybody, and have a lovely day.